In this video, I'm going to answer you the question of whether you should invest in Boohoo now with my stock analysis. Disclaimer, I'm not a financial advisor, and if you seek financial advice, please see a licensed professional. Firstly, I'm going to quickly mention the recent news so that I can get it straight out of the way. On Sunday, the 5th of July, an undercover reporter exposed one of the factories linked to Boohoo because apparently they were paying their staff around £3.50 an hour. Following the next day, the stock market, the Boohoo stock tanked around 30%. Then Boohoo stated that they will investigate these claims and invested 10 million into finding out which of their suppliers are not doing things by the books and legitimately. And whilst this happened, the stock price continued to plummet till eventually it was down 50%. And then subsequently they were dropped by other retailers such as Next, ASOS, Amazon and Zalando. About a week later, the price has been highly volatile, between 280 pence per share and 200 pence per share. And then another article was published showing both the co-founder and the owner of a factory, which was one of the suppliers that had been busted for this modern day slavery. And they were in a picture partying together, so this doesn't look good. Following this news, the share price has tanked again and it's sitting at around £2.30 a share as of close on Monday. Because of this, the investors were spooked and selling out of their investments, causing a large drop in the stock price and subsequently half of their market cap being cut away. A lot of ethical, social and governance funds as well have had to sell out, such as Standard Life Aberdeen, in which they had liquidated a majority of their shares with them, which has led to a more attractive valuation, such as a price-to-earnings ratio of 43 times, which does look very steep. It is lower than what it used to be. Historically, this price-to-earnings ratio was sitting around 70 times in June, and in fact, the average for the last 5 years is a price-to-earnings ratio of 70 times, suggesting that whilst they usually trade at a serious premium, they are currently discounted to their regular or standard premium, suggesting that there is some value here if the premium were to return to its recent peaks. Typically, this means that investor sentiment is higher, it's more likely to outperform the market, or that's what shareholders believe, and therefore it will also outperform that of its industry and its peers. And this is actually backed by their price to book ratio, which compares their net assets to their market capitalization, and their price to book ratio is 10.4 times, which is greater than its industry of 3.9 times and subsequently the market of 1.3 times, suggesting that yes, they are severely overvalued compared to their assets, but historically they were trading higher and at a premium more consistently, such as in June they were trading at around a price to book ratio of 14 to 15 times, and currently a third of that value has been wiped off. However, fundamentally, this company hasn't changed, and over the last 5 years, they've managed to grow their earnings by an annual compound growth rate of 35.2%, outperforming of its industry of 12.7% and the market of 13%. If they're able to continue growing the business at this rapid rate, then it's very likely that the earnings per share is going to increase too. And whilst effectively at the moment, if you bought the stock for around 200 pence and you bought every available share for 200 pence each, you would have a yield of around 2.5%, which is very low, meaning that for every 200 pence of the share you buy, you only get 2.5% of earnings, so 5 pence earnings. When I would consider this, I would hold this long term, and therefore it would be more attractive as their earnings per share growth is actually quite strong. And in fact, over the last 5 years, they've managed to grow their earnings per share of 48.52%. And if this was reflected in the share price and the stock returning to its previous premium level, then surely you would see outstanding capital returns from the growth aspect. Right now, only 40% of you watching this video are subscribed, so if you're interested in my stock analysis, my stocks to buy, or my investment journey, then please consider subscribing, as it is free. Thank you. Where Boohoo really has strengths is its impressive previous statistics, and in fact they'd managed to generate a return on equity of 22.2%, which is outstanding for the company, and it means that the shareholders' equity could be reinvested at a rate of 22.2%. Boohoo also has a return on assets of 10.9%, which completely outperforms its industry of 5.7%. This effectively means that they can use their assets to generate profits around about 2 times more efficiently than others in the industry, making them stand out as a company and a great growth opportunity. But where they really shine is their outstanding use of capital, and their return on capital employed is actually 25.9%, which has been fairly consistent in the last 5 years. And 3 years ago, this was 25.1%, showing that they are able to keep up with the increased growth that they are providing. And with this means that their capital available, their cash, they can reinvest it straight back into the company and get returns of 25.9%, which is really strong for a growth company. And furthermore, this would suggest that the management is very competent. They know what they are doing, and therefore they can generate these strong returns, and investors would be happy. And this would mean that they are more than able to continue growing earnings at their historic rate. And in fact, this is also backed up by the analysts, in which they have predicted over the next 5 years that it would grow by 28%, which, yes, is a deduction of 7.2%, but this is still a very strong growth rate. It can still be inferred that this company can grow faster than that of its peers in the industry, and therefore sits at a higher attractive valuation, at a higher premium of a valuation, because investors are so bullish on it, and therefore would generate a strong return on investment. And whilst Boohoo doesn't pay a dividend, if you'd have bought this stock 5 years ago, you would have seen returns of 872%, which completely outperforms its industry by 8 times. Not to mention it outperforms the market by 884%. I should also mention that the founder of the company still owns a majority shareholder position, in which he has 17.45% holding of shares in the company, effectively meaning that he's got skin in the game. This means that he would not want these shares to just suddenly drop and tank. He wants these values to go up, so he has a reason for this company to continue growing rapidly and improve shareholder returns, as after all, he is a large shareholder in the company, and therefore their best interest is to increase the profitability and shareholder returns. And currently, I feel like the sell-off was way too overreactive. There are a few news articles stating that there were some modern-day slavery, but this is not even Boohoo. This is their supplier, which had contracted it to subcontractors which were in a separate factory, and for Boohoo that is very hard to keep track of. And it also seems like the news is being repeated. They repeat the news more, the share price will drop more, and it seems like the media are really trying to push this stock down. And this is furthermore supported by the idea that this was shorted. There was a 20 million short placed on this a few days ago, in which it had made up around 8 to 9% of their total capital. So this wasn't just a random small punt. They were likely pushing the media, I'm speculating here, they were likely pushing the media to repeat these articles or slightly alter them so that it looks more scary and therefore investors sell off. And up until September, it's very likely that volatility is going to continue. And this would be a great time for them to short it, as they can still get these reactions with the volatility. But it's sort of a transfer of wealth, as what they're doing is they're kind of shaking up investors, stop losses are being hit, share prices drop, then funds or institutions could buy in a more attractive valuation, and therefore kind of transfer wealth from the poorer to the rich as a process of life. I believe that this stock has extremely high growth potential, and even though Next, ASOS, Amazon and Zalando had pulled their merchandise from their websites, it only represented 4% of their total revenue. And yes, it is important they do get this back, as it represents the brand's importantness and stability. The customer base is only 16 to 40 years old, and they are less inclined to care about ethics. After all, you would likely want to buy a cheaper product if it is of similar quality, despite it being made somewhere with lower respect towards wages. I know I would. I don't have the extra money to donate in that regard. And a similar thing has happened with Primark in the past. A few years ago, a similar scandal had happened, and so people had forgotten about that. This audience is likely going to care about it or mention it for a few weeks, and then it's likely just going to die down and be forgotten about. That's at least what I believe. Also, as of recording this video, the company have got a bonus in place after acquiring Pretty Little Thing. And this is the idea that if they're able to hit a target of £6 per share by 2023, then they are rewarded 150 million in compensation, effectively meaning that the board will try extremely hard to hit this target, and this looks very promising for shareholders. Some people have mentioned the idea of perhaps suspending this or cancelling it, this can look more promising from a management standpoint in reflecting the whole situation. However, I think it doesn't matter that it's still here. It's more inclined that they are looking to generate even more profits, increase the share price, and subsequently shareholder returns. I've personally bought into this stock, and you can see it on my portfolio update up there, and it is a substantial position in my portfolio. This week I've added more. It's around 30% of my overall portfolio. I'm very bullish on the outlook of the company, and my price target, to be honest, would be around £2.60 or less, as I think it has excellent long-term value. What do you think of Boohoo? What price did you buy it at, and how long have you been holding it for? I'd also love to hear suggestions for the next stock analysis video, and the most popular comment down below will be my pick, although I'd prefer to do FTSE 350, as that is where my speciality is for the current time being. Thank you for watching. I'm Osborne Foreman. Have a great evening, and I'll see you Thursday at 4 PM.